Absolute myth. Absolute myth.
And the property may just go on the market and someone else buys it, or the property goes up in value. So hi, welcome back to Finance Matters podcast. My name is Rahul. With me, I have Adrian, and we are from the Team Lenders Club. And today we have a really great topic on our hands. We are going to discuss about Tier 3 lenders. Before we get into that, Tier 3 lenders are a special breed of lenders who allow you that extra borrowing capacity, first of all, and also help you in certain situations when Tier 1, Tier 2 lenders have told you that they are maxed out or they cannot help you. So if you want to keep going on the pursuit of buying properties, or if you want to just get that extra property under your portfolio, this video might be for you. Now, Adrian, why don't you start us with, first of all, what is the difference between Tier 1, Tier 2, and Tier 3 lenders?
Of course. So then the hierarchy of these lenders, the Tier 1 lenders, you're looking at your big four banks, so your CBA, ANZ, throw in Macquarie in there as well. When you're looking at Tier 2, it's just a slight step down, looking at lenders like Newcastle Permanent, Suncorp, and even Bankwest as well. Now, your third tier are your non-bank lenders or non-conforming lenders. So they have a lot of very niche policies that your first and second tier lenders don't offer at all. And they are solution-based lenders. So they know you're not going to be with them forever, but they're there to get the deal done for you, whether that's buy another property, refinance, pulling out equity, things like that. They provide solution-based lending.
Yeah, solutions to problems like higher borrowing capacity, low doc loans, SMSF loans, bad credit history. So this is when Tier 3 lenders come into the picture, and we will go through each of these points now. So the first point that you mentioned is the higher borrowing capacity.
That's right.
In today's climate, when borrowing capacity is so restricted because of higher rates, how do these Tier 3 lenders come and help us? Tell us.
So these Tier 3 lenders, when assessing, most lenders will assess the new loan at a increased buffer of, say, 2.5 to 3%. These lenders are actually servicing with a buffer of 1%, meaning there's a lot more borrowing that can happen because they're assessing at a lower amount. This also, for some lenders as well, is taken into account for current repayments. So again, that is also buffered with your first and second tier lenders, but at some lenders, they don't buffer the repayments of current liabilities. So whatever you pay per month, they will use, meaning again, an increase in borrowing power. Alongside that, well, for all of the you investors out there that have investment loans, they do take negative gearing at the assessment rate. So again, that is an extra boost of borrowing on top, and that's why we do see a vast difference between your Tier 1 and 2 lenders versus Tier 3 lenders in terms of borrowing. They just have those small little niches I mentioned to help increase the borrowing and just push you over the edge.
Those are all great points. This is how basically the serviceability calculators work with these lenders. And for you, the end result is that you get 100, 200, 300,000 more in your borrowing capacity, which allows you to go for that property that you always wanted to, or just add some more to your portfolios. Now, as you mentioned, that the strategy is to eventually, first of all, get the property and eventually move Tier 1, Tier 2 lenders, refinance to them.
That's right.
So they are getting the job done. They are the solution-based lenders. And
Correct.
Once that job is done, once your financial situation improves, your borrowing capacity goes up, we can always refinance you back to one of the major lenders if that is your goal. Or if you still want to keep buying more properties and Tier 3 remains the only option for you, we can just keep going and do the same for you.
They know you're not going to be there forever. That's why we've mentioned they are solution-based lending. So it's weighing up the option of, do I go to a lender like this with some different niche policies and different name, rate, or do I miss out on the property? And most clients don't want to miss out on the property. One of the next points we're going to discuss is, you mentioned it before, credit history. People with bad credit, can they get loans with a third tier lender?
With the Tier 3, yes, but certain major lenders like Macquarie, CBA, or other major lenders, it's if you have a default, if you are discharged from bankruptcy, if your credit score is low below a certain threshold, the major lenders will mostly say no to those situations. There are certain lenders who will allow this with explanation, but not for things like bankruptcy.
No.
So this is where Tier 3 lenders come again, and they look at your credit history, but they have higher appetite for these lending situations.
It's a bigger risk, essentially.
It is a bigger risk for them, but high risk, high reward is how they go by. But basically for you as a client, that allows you to go into the property even if in past you had bad repayments, untimely repayments, defaults, anything that may impair your credit history.
Like generally, the first and second tier lenders will basically say if you have a credit score of 650 or below, they will decline you. Now, with tier three lenders, they don't have such internal scoring. They won't credit score you. So they won't look at the number and dismiss you. They will look deeper and they'll look further into it with explanation. So the biggest example I can think of is bankruptcy, where clients have been discharged from bankruptcy within a certain time frame. Your major lenders, your tier ones and tier twos, aren't going to look at it for an extended period of time. I believe it's about 7 years. Whereas you've got some third tier lenders that within 1 day of discharge, they can actually help you with a loan. 1 day. So there are some of these lenders that have these policies that allow clients in specific situations with bad credit score, defaults, misrepayments, things like that, or even credit cards that didn't know were still open, that weren't closed, and you're still, there are repayments that weren't made on that, even 1 cent even, where it creates a default. They can still help.
Another way that these tier 3 lenders can help you are for self-employed clients. If you have any self-employed clients whose income has gone up recently than their last financial tax returns, or if for some reason they don't have their company tax returns, financial statements prepared for the last financial years, they have the option of low doc loans for them. So for low doc loans, it's simpler verification, I should say, by these lenders, that they can just go through the last 2 business activity statements or the accountant's declaration of income for the applicant, and they can get loan but just based on those statements. So this comes in handy a lot because a lot of tier 1, tier 2 lenders, they want the most recent year's financials prepared, the most recent 2 years financial even, and they average through that.
That's right.
Whatever their criteria is for borrowing capacity. But that's where the difference comes from for tier 3 lenders, that they are fine to look beyond those approaches, the conventional approaches, and use their own unconventional common sense approach, that if the business is doing well and we have the business activity statements as an evidence, or an accountant is ready to declare their income, they would go by that.
It doesn't mean it's easier. There are still processes in place to look over the accountant declaration. They speak to the accountant as well to confirm the business activity statements as well. But yeah, like you said, it's more for clients that don't have the most recent financials, but they're in a position to purchase a property. Like you said, the business has increased its income, but they just don't have the financials right now to reflect that, to go to a tier 1 or tier 2 and go through the full verification process. They might miss out on the property, and that's their
Or they would have to wait until that financials are done, and by the time the property may just go on the market and someone else buys it, or the property goes up in value. So rather than having to wait for that long to have everything prepared, to get your financial sorted, it's sometimes easier and best to just go through a low doc loan, get everything done, get the property that you want, and then just move to the tier 1, tier 2 lender that you can find later on.
Again, solution-based lending. It's all about providing solutions. As brokers ourselves, we come to the clients and provide them with solutions, and a low doc is just another one of those policies that provides a certain product to the client so they don't miss out on that property. And like you said,
This is a niche that only tier 3 lenders have. None of the majors, none of the tier 2 lenders would allow low doc loans anymore.
No.
Speaking of loans which are not allowed by tier 1, tier 2 lenders, there comes a really interesting.
My favorite, in fact, actually, SMSF lending. So SMSF, basically, you've got your industry super fund that has been rolled over into a self-managed super fund, and you can actually purchase properties in there. Tier 1 and 2 lenders used to provide this sort of product, but have all pulled out many years ago. So now it's third tier lenders, non-bank lenders that are providing technically trust loans through your super.
Such as Pepper Money, First Mag, Granite Home Loans, and some other lenders who are really good in this space.
That's right.
And that allows you to have the parallel borrowing capacity under a limited recourse borrowing arrangement. Speak to your financial planner and accountant more about that. This is just general information. But from lending side, tier 3 lenders are who will help you with SMSF loans in future if you need.
That's right. So we do see clients that can't buy property in their personal, but they do have money in their super, and they would like to have invest that accordingly. Like you said, speak to a financial advisor in regards to this about the practices, but it's another way that clients can purchase property in their super to help them further along the line when it comes to retirement.
Tier 3 lenders also help with certain income types, such as workers' compensation without the return to work date. So, none of the majors that I can think of will allow, maybe one or two majors will allow that sort of income, but that also is on a case by case basis, on exceptions. But Tier 3 lenders, there are more than a few who will accept workers' compensation as well.
But actually, a big question, Rahul. We see your tier ones, your tier twos, all really well known banks. Now, the tier three lenders aren't as well known. So, are they safe?
That's a great question. This is one of the most frequently asked question. Are these lenders safe? These are still ASIC regulated.
Okay.
They still have to abide by the lines guidelines set up by APRA. They, if you are depending on the structure you are buying in it, they also have to abide by NCCP. So these lenders are safe. They have their own funders. That's the only difference. But then when it comes to safety, it's like they are lending you money. You are not lending them money. So worst comes worst, either you don't pay your debt back or the debt gets purchased by some other entity and you pay the same and the life goes on the same for you.
I mean, a lot of clients wish that they didn't have to pay back their debt. So, no, that's right. They're lending you money, and essentially, if something was to happen to them, which is highly unlikely here in Australia, your debt would either disappear or would just be bought out by another bank or lender.
Another question that people ask when we mention tier 3 lenders, that does it impact their credit history? They just think that because the term tier 3 is used, that it's gonna somehow make them look bad in terms of in eyes of other banks, in other eyes of other lenders, and it's going to impact their credit history.
Absolute myth. Absolute myth. These lenders have zero effect on your credit score. Every bank or lender will look and check your credit score, but just because you've gone to one of these lenders doesn't mean a bank or another lender is going to reject you because you went to one of these lenders. Absolute myth. I see it all the time. They are completely safe, as we mentioned, and have zero impact on your credit score. You are not judged for going with one of these lenders.
In some of the instances, when we have to refinance back to one of the major lenders from a tier 3 lender, their assessor might have asked once or twice, maybe at best, then why did they go to this lender? And we just
But there are reasons. There are real reasons. Like, for example, the LODOC situation. They had to go LODOC, and they needed to purchase a property. Now we have full financials.
And even we can mention that they had bad credit history in the past, but now it's improved, whatever the change has happened. And now they're coming back to refinance to the major institution, and that's fine. That's completely acceptable.
Yeah.
So as long as we just provide proper explanation, even those questions which are very few and far in between, those can be handled pretty
They're
easily.
more just ticking boxes, essentially, just to make sure everything's covered. But complete myth, to be honest.
Yep. And now because like bad credit history, higher borrowing capacity, all these things are involved. That's why the high rates are also come into the picture, because they are high fees. They have to pay valuation fees with most of the tier 3 lenders. There are some application fees, some risk fee involved.
That's right.
So it's an expensive option, a little bit expensive than your normal tier 1, tier 2, but it still allows you to get that property that you want, which may just increase and justify the cost that you are paying more by going to a tier 3 lender.
Exactly, justifying the cost of paying these fees and rate, or missing out on the property. Like, what is more important to the client? And again, these lenders understand that you aren't going to be with them forever or a long period of time. Like I said, they are there to provide a solution, whether you're there for 1 or 2 years max, to then when you do have a better
depending on your financial situation. If you still want to keep
Exactly.
buying properties, if you are a professional investor, then higher borrowing capacity is what you need. And tier 3 lenders are the ones who are going to allow you that.
That's
so
right.
you might as well stick with them. But if not, we can always refinance you back to one of the major lenders after that. I mean, as I just say that if tier 3 lenders were on a dating profile, their bio would be, we are here for a good time, not a long time.
It's right, and they know that. As long as they know that and they understand. But like you said, if you're in a position to keep buying properties, like we discussed, they look at the repayments, the actual repayment with no buffer. That's really going to help you build your portfolio. So there are a lot of pros, a lot of cons as well, but at the end of the day, It's all going to be down to you and your financial situation. So definitely speak with your local broker in regards to see if an option like this for your next purchase will be right for you. And that brings us to the end of the podcast. I hope you guys enjoyed and took some very valuable information. And until next time.